All right, well, Ben did me the extreme disservice of building this up. But fortunately, Ben is going to provide the entertainment. He's the one who put the pressure on us. He's going to have to follow on from that very insightful and entertaining panel he just led. So one of the things we did learn from the prior panel, from the esteemed Mr. Bugbee, is that none of these gentlemen lies. So we can take what they say at absolute face value, and that they will undoubtedly be correct in their prognostications. There we are, last two gentlemen. Thank you. Fotis and James are here. So what we've decided to do for today's panel, and we do recognize that we are all that separates you from the adult beverage of your choice, we will move expeditiously through these topics. But we wanted to start first and have the guys tell us what their best picks were and what their worst picks were, and tell us sort of where they got it right and where they got it wrong, and see, first of all, what we might be able to learn from that. So why don't we start with, we'll just go right across. John, you want to lead off?
Sure, thanks, Ted. And I think as an analyst, we all like to think we're never wrong. So we'll take that. But as we look back towards the summer, we saw dry bulk rates come off significantly from the April highs, and we saw sentiment follow the dry bulk market, basically overselling to a point where, if you looked at the steel value chain, you had steel margins at the mills remaining at all-time highs. You had production levels remaining at significantly elevated levels, and then you had that incentivizing more demand towards the iron ore and coal segments, particularly in China. So as a top, pick over the last 3 months has been dry bulk, and has been playing the basically momentum moves that investors have made in the segment. Now straight into worst.
Sure, why don't you tell us? So your best pick was dry
bulk, and
long, and your worst pick?
Worst pick within dry bulk,
or whatever you want, any sector, but
any sector. I would say particularly LPG.
Ooh, wow.
And that's been just on a basic factor that we have seen the market itself go through, primarily, again, all-time lows, and we're starting to see sentiment turn within the market, irrespective of the fact that rates are remaining through, or OPEX levels are below OPEX levels at around $13,000 a day. We're still seeing now investors take a more longer-term view on the sector.
Okay, and that's helpful. Gautam?
Yeah, so I think our most accurate pick, I think first of all, dry bulk is something we were bullish on since sort of middle of last year, but I think we did not estimate the extent to which the market would go up, and it surprised us to the upside. But what we were correct on in terms of accuracy was probably the crude oil tanker market. We cover 5 crude oil stocks over here in the US. And so in the second quarter of last year, we downgraded most of these stocks to neutral. And then we followed that up in January. We downgraded them to unattractive. And so I would say within stocks, if we look at most of the stocks, we were pretty sort of dead on in terms of what we thought the stock prices would be. So for instance, I think TK Tankers, in January, when the stock was 2.4, we had a target price of 1.8, which is something it hit in June of this year. So that's, in terms of accuracy. Now, what we were wrong in is probably Golar, also generally the LNG sector. We were expecting perhaps for that sector to perform better than it has. And again, I think in particular, a stock like Golar, we're still very bullish about the long-term prospects of that company, particularly with its FLNG business. But there have been delays which are widely known, and that's affected the stock price. So we had, the stock didn't really work out the way we were expecting.
Thank you. James, go ahead.
So sector-wise, I guess the best pick was dry bulk. We're very bullish. We still feel bullish. We think we're at the start of a sustained recovery moving into 18 with mid-cycle rates at 19. It's playing out nicely. Hopefully it stays. The worst pick we've had was, I guess, the biggest miss was the tanker recovery to occur at the end of this year. We were a little bullish I believe on the scrapping potential in this year ahead of the IMO regulations. Scrapping has picked up in the tanker space, but not to the extent that we expected. And with the regulations being pushed out to 19, we don't feel that a recovery is going to take place until 19. So that was our miss. On the equity side, our best pick is on the tanker side. We were short on Nordic, initiated at 9 with a $7 target. We've been steadily lowering our price target to 5. I think it's now around 550, but it flirted with the 4, so I think that's been our best stock pick. And the worst stock pick was probably, I would have to say, Dynagas. I think we were a little bullish on this short-term spot earnings potential of Dynagas. Rates have not recovered as much, and when you have an Arctic trading vessel trading on a spot market with not enough cargoes, the rates are going to be low. So those are our picks.
Fotis?
Yeah, I think that your question, the answer to your question depends on the time horizon that each investor has. What I noticed, we had a field trip to Europe last week, and we met with around 60, 70 companies. And when you were asking the public companies, they were all bullish for dry bulk. They were all frozen about tankers. None of the tanker companies wanted to buy any assets. But when you were asking the private companies that they had liquidity and cash, they will tell you it's time to buy crude. Asset prices are very low. Order book, yes, it's very heavy for next year. It was heavy last year. But if you are looking for 2019 and 20, crude tankers offer a unique opportunity, and I would say something similar for LPG. The problem is that you need to have horizon, and I think for this bet, both for crude tanker bet and LPG bet, you need to have balance sheet. So I would think that it might be a little bit early, but it would be interesting to look at companies with like Euronav, like DHT, companies that they have strong balances that they can go through the current weakness. The dry bulk market, in my view, is going to be great for the next 12 months. Of course, China, the last few days, has given some signs of concern in terms of tightening from the government. But I think that the supply picture is very strong, and we still haven't seen the Brazilian exports coming. But this is more of a trade for the next 9 months, probably 12. It's near its highest point. If I had to say to pinpoint on one stock for the next 3 months, I would focus on Golar. The vessel sailed off coast of the Hilly FLNG sailed off course of Singapore, and by the end of October will be in Cameroon, and by November it will be generating cash. I think this is a very interesting stock.
Okay, that was an excellent prospective look, which we'll come to. So we're going to come back to you because we're asking what you picked about 6 or 12 months ago that panned out right and panned out wrong. So we'll come back to you.
Half of what I pick goes well, half the other.
Okay. We'd like to explore why, or is that just you flip a coin and that's how things work out? All right, Ben. So we expect some entertaining remarks out of you aside from just answering the question.
Well, first of all, Spiro's just pointed out that he has to read a statement from his compliance officer. I probably should too, so just whatever he reads, substitute Stifel for UBS, and you've been notified. Away from that, probably from a worst pick, unfortunately, it's probably the product tanker stocks. I came in with an awful lot of conviction and was awfully wrong with only one exception. The only one that's up in the last 12 months is Ardmore, but all the rest of them have not worked at all. And despite my having just been on that panel, but I would say the one that I'm probably the most proud of, or the luckiest on, perhaps, it just has happened in the last 6 weeks or so. I upgraded the shares of one that probably didn't come up at all today, but Madsen at $22.
And Jones Act doesn't count. Try again.
Jones Act container trade. Shares fell on one particular day pretty sharply, fell to about $22. I called as many people as I could possibly think of to try to get some insights, and spoke to really all the people in a position of power in every company, and decided that some of the fear that was in the market was far too overblown, and that nobody had any desire to do anything irrational whatsoever. So I was like, well, here's a good opportunity for mispriced stock. In the last 6 weeks, it's up about 35%. So.
Yeah, sorry, as Ben mentioned, I'm going to have to unfortunately read this statement, so just bear with me, it's quick.
He wasn't joking, folks.
No, yeah, feel free to sue these guys, though, when it happens. So, as a research analyst, I'm required to provide certain disclosures relating to the nature of my own relationship and that of UBS with any company on which I expressed a view at the conference today. These disclosures are available at www.ubs.com/disclosures. I swear there's no viruses there. You can click that link. Alternatively, please reach out to me and I can provide you with them after the call, or after the conference. All right.
Well done.
Yeah, so apparently investment banks don't like getting sued. It's a surprise. So best call, I heard TK Tankers before. That was ours as well. We basically ended up downgrading those guys to sell when they were trading around 270. Main driver, we just really didn't like Suezmaxes at the time. A lot of what we saw happening was dislocation in Suezmax rates relative to VLCCs. Historically, they would trade in line, 80% call it on the rates, and that had really been declining down towards 50%. And obviously, TK Tankers has a lot of Suezmax exposure, especially after the Principal Maritime transaction, something we really just couldn't get behind. So put a price target on those guys of about $1.75 at the time. After they did the TIL transaction, we doubled down on the sell, cut the price target down to about $1.50. It ended up continuing to trade down. So all in, we thought we did pretty well on that call. Unfortunately, we're getting into the one that we don't like, which is where did we mess up? To much happiness, I'm sure, to Mr. Bugbee. It is one of his stocks, and so going short on salt ended up ripping my face off. So little thing happened here in the U.S. in November called the U.S. election, and anything that was a little bit risky was just off to the races after that. I'm not just going to blame that. Obviously, the BDI and Capesize rates were off to the races too. So we ended up missing that call. Those names really rebounded. We're too late on this first leg, but we're sticking with the sell at this point. So not giving up yet.
All right, very good. Fotis, you want to add anything, or you just said about half are good and half aren't so good? We'll stick with that.
No, if you want something more specific, I think that the best call and the worst call was, I think, TK for me.
TK?
I would say both at the same time. I think I caught it right that TK Offshore was pretty much at the verge of bankruptcy. I didn't expect that Brookfield will come and bail out both the bondholders and primarily the equity holders at this kind of valuation, which created a short squeeze and a jump of the TK parent stock. So I think that, and I would also add CSPAN. I think I was correct on initiating underweight at the beginning of the year of the stock. I just thought that it will drop much further than it did. The recovery of or the improvement of the containership market since February, it has helped the stock rebound and not to reach the lows that I thought it would.
Okay, that's helpful. So three of you guys, your best call was a short, either a sector or a specific name. There were obviously a couple of long sector calls, although John, if I remember our discussion separately, you called dry right, but you called Eagle Bulk wrong within that, your own admission. So, what's harder to call, guys, a good long or a good short? Don't all jump at once. Ben, go ahead.
Oh, that's easy. It's much harder to call a short because you really have to put yourself out there. in that this might be hard to believe, but people don't like to be told that their stock is garbage. And it can ruin relationships. It can irreparably crush investment banking business. And as much as we all are dislocated from that, we all work for investment banks. So it takes some real guts to go out with a hard short call.
Okay.
I think that impacts the natural biases.
Okay.
No, I agree with the pressure that sometimes you get for having an underweight, but I think it's much easier in the shipping space to have a high degree of confidence on a short. And the reason is that there is a clear catalyst, and usually is a broken balance sheet. While a long, the problem is that you hope that the market will get better, and you do not know if LPG market will get better in 2018, or it's going to be in 2020 or in 22. I mean, you hope, you have a view, but your degree of confidence is not that strong. But when you have a broken balance sheet, sometimes even if the market recovers, you know that this company is a short. You know that, I'm still underweight on CSPAN, although I have been, the last few months I have been wrong, because simply we know what the cash flows of the companies are. They need to raise equity.
I would just go back to what Ben said. I mean, it really comes down to risk reward, right? If you're going to go out and stick your neck out there on a sell call, you better be really sure you're going to be right. There's a whole lot of downside in it and a whole lot of upside too. If you make a really great sell call, you stick out of the crowd. There's obviously more buys on the street, typically speaking, than sell ratings. And so good opportunity to stick out and set yourself apart from the crowd. But at the end of the day, you better be right at the end of it. So high risk, high reward, is basically the way I look at it.
Okay. So turning to, it seems a big part of your guys' job is making the right sector calls. I think it'd be helpful for everybody to hear, what you look at. You can choose a sector because I know they're all, I'm sure you look at order books and charter coverage and all those sorts of things, but be good if people would just give a primer. You can choose any sector you want. Let's try not to repeat each other, but give us the top 3 to 5 items that you look at in making a sector call. Let's see, we'll start one over. Gautam, you can start.
Yep, okay. So when we're making a sector call, I guess Drewry, we've got macro research, so we're driven very much by what our macro guys tell us. But yeah, depending on whether they're bullish or bearish on a stock, we either, that is a big weightage factor. We also look at what I would call risk of bankruptcy. So we like to back companies which have a strong degree of longevity. So we look at companies, we look at the charter coverage, we look at the break-even of the vessels. We look at the dividend policy of the company, historical dividend policy. We look at the sponsor's shareholding in the company to assess how aligned the sponsors are with the other common shareholders. And then finally, of course, we look at also the independence of the board.
Okay, James?
Also, when we do a sector analysis, we start from bottoms up as granular as we can, and then work our way up. Like on the dry bulk side, we'll start with each individual commodity, broken up by sector. So, grains, coals, rice, we'll go as granular as we can, and we look at what the demand growth will be, project that out, and then we'll look at where the exporting regions are and where the importing regions are, and that'll tell us our ton-mile demand growth. And based on that, we'll roll that up into vessel classes and vessel speed for the fleet, the current fleet growth and the order book, including scrapping and slippage, forecast that out about 2 to 3 years. And whatever number that gives us in terms of a supply demand on the tonnage, that's what our sector call will be.
Okay. Fotis? Anything you want to? Or has it all been said?
I don't think I can add something more intelligent than what we have already said. We all obviously will look at the order book, and we need to know if how many ships they are coming, and then certain catalysts in each particular sector. For example, will the ARBs for LPG will open next year? are the prices the price of oil is going to make more attractive LPG versus naphtha, these kind of things. Are Brazilian iron ore exports are going to expand the ton mile, and we're going to see an unusual an unusual increase in demand beyond the regular trend.
Okay. Well, so it sounds like generally you guys are all agreed on your sector outlooks. So I guess we should presume you all are looking at the same facts and should have very similar views on the sector. So hands up, dry bulk long, bullish for the next 12 months.
Next 12 months?
Yes. Okay, good. We have something to talk about. Spiro or Ben, lead off. Tell us why you're not.
Yeah, I mean, next 12 months is, I guess it's pretty narrow, but generally speaking, I think everyone feels pretty good about the supply side, which to your point is something that we're all, is very visible and right in front of us. We can see the order book, we can see that data. I guess what's less apparent is the demand side, right? And I think when we talk to our metals and mining team, we look at the fundamentals for coal, the fundamentals for iron ore. It's just not playing out, or doesn't seem to be playing out that well over the next few years. And so we're actually forecasting negative CAGR growth for both of those commodities from a trading standpoint over the next 5 years. And I think if that's the case, you can do what you want with the supply side. If your demand is falling, and even if your supply is growing by 1%, that's still bad.
Okay.
I'm a little bit less draconian than that. But what I would say, though, is what really bothers me about the dry bulk side is I do think that you are facing some level of structural demand growth. And while it's okay at the moment in terms of iron ore trade and coal is even all right, I think we're probably, incremental growth is probably about as good as it's going to get. And already we've seen, even though the rates on the ships are better but still not good, there's been a marked change in activity from the supply side. A lot less scrapping, a lot more ship ordering. What that means is if your demand is a relatively thin margin, it takes a relatively thin margin of supply response to offset it. And I think that lends itself to a less volatile cyclical recovery, and frankly, probably not a whole heck of a lot better than where we are right now. And while the supply side's low, and I don't think it's going to get worse, I think if asset values appreciate by 5% or 10%, you have a little bit of upside in your shares, but not a lot of upside. And I think there's some anticipation that things are really going to go gangbusters. But if dry bulk demand grows by 2%, it's hard to go gangbusters.
John, Gandolfo, you want to chime in on the bull side?
Yeah, so I disagree a little bit. If we look towards purely on the fundamentals for steel-making margins that we've seen the reinvestment take place in the iron ore and coal side. On the mining side of the business, yes, we've seen some orders come back into the dry bulk market, but it's still, as a percentage of the overall the overall fleet itself, it's still relatively at significant lows historically. So I think that, yes, we might see, at least on the shorter period going into the winter heating season, China, some environmental regulations basically weigh on the market overall, but I think the trajectory is still towards more improving markets, especially over the next 12 months. I think that's going to definitely play itself out.
James, you want to go?
Yeah, so if we're talking 12 months, I think there's a lot of positive sentiment. And there's one wild card people aren't talking about is the current VLOCs that Polaris is operating. The Stellar Daisy sank, it capsized, and the Korean register is supposedly doing some investigations to make sure that these vessels are seaworthy. There have been new orders placed for replacement VLOCs. But in the interim, within 12 months, there could be a chance that a number of these vessels are taken out of the market, and Vale will need to tender COAs, and they will have to go on capes. There aren't VLOCs out there for these tenders, so that should help with short-term fundamentals. And longer term, I mean, if you look at what China's doing, it's a little different. The latest 5-year plan, they're calling for targeted infrastructure spending. Instead of those ghost cities they're building in Western China, they're building out from within existing cities like the Pearl River Delta, and that's attracting new workers. And that ties in directly with what they're doing on the economic side, which is moving from agrarian to a services-oriented industry. So with the move to a services-oriented industry, you're going to have a larger middle class. Two things the larger middle class does: they drive more and they eat more meat. The Chinese, they will need to import a lot more soy and grains. Soy for animal feed and grains, aside from rice, to feed the growing population. I think with those fundamentals there, and as Fotis mentioned, the S11D mine, that's still not operational fully. We have the Samarco restart coming on. These projects will go ahead, and that supply has to go somewhere. So Vale is not going to mine and keep it piled up in Tubro or on a port somewhere. These will find destinations in long-haul trades, be it in Northern Europe, where the steelmaking industry is doing better, or in China. I think with the Chinese steel mills, they're all pulling in more higher grade iron ore. You want something with 65 to 67% Fe content, which is what you find in Brazil. And just a ton-mile difference between there and Australia, I think that's going to have a positive effect.
What's the biggest risk to that thesis, out of curiosity?
Oversupply.
In 12 months?
Well, I can see, well, that's another thing. So, the Chinese have been pretty bullish on their steelmaking capabilities, right? They have been pushing for Chinese-built vessels. I could see a point in time where the Chinese have more aggressive financing. They will give Sino-Shore cover, so you have a lower cost of debt, and ship owners might go and order vessels. I mean, you don't need to go to South Korea or Japan to build a Cape or a Panamax. You can go to China and get a high-quality one. So that's probably the overhang there.
Okay.
And I would say the other big risk that is there for this market is overheating of the property market in China, and perhaps a reversal of where we are. I think last year you had most cities in China having appreciation in property prices, and this could very well reverse. And that we don't really know what effect it will have, but that could be negative.
Well, I mean, the Chinese have the monetary controls, right? They're trying to keep money in China, and these investors need to invest it. They can't go to the U.S., buy apartments on Fifth Avenue anymore. They have to invest within China. And I think that's going to help spur additional growth in China for the next maybe 2 to 3 years.
Okay. Excellent. Fotis, you want to add something, or you said?
I will just repeat something that a trader, dry bulk iron ore trader mentioned to me, that his visibility is not more than 3 months. So that's the problem with the dry bulk market, that you cannot have a very long-term view. And I share Spiros' concern long-term, what is happening after Vale brings all its volume. Is China still going to be there growing by 1 or 2 or 3%, it's still production, or we're going to have a market after 2019 or 20 where still production will be going down. But that's not a problem for public equity investors. It's more of a problem of the ship owners, that they have to think 5 years ahead or 3-4 years ahead.
Yeah, so let's pick up on that, because, I think implicit in what you guys do is some correlation, some timing between what's happening in the underlying trade, specifically rates, and how that translates to a stock price, and at the same time how that translates into asset values or EBITDA multiples, as every CFO in this room thinks shipping companies should be valued on, right? Yes? So tell us about how you guys triangulate among your fundamental belief in trade flows and hence day rates and stock price action and valuation. Let's see. Yeah, Ben, you look ready to go.
Oh, man. I was hoping for somebody else to give me a good idea how to do this. I think that the truth is that, honestly, my view on that is changing a bit. I think and that started probably in late 2014 and 2015, where all of a sudden the tanker market rates were great, asset values were screaming, and the stocks did nothing. And historically, there's been this tight correlation. But in that particular instance, we were dead wrong from we were technically correct, but dead wrong from a stock picking perspective, and the vast majority of us were. And I think you can almost even say that in the last, let's call it 6 months of the dry bulk trade. You had a big run up in anticipation of a good market, and then finally the market began to do well, or at least better, and the stocks have been absolutely flat or even lower. And I think it's changing. I think that as there's more eyeballs that are looking at this space, there is more anticipatory money that's being put to play, and I think we'll see. I think momentum is certainly the key, but it's not as easy as it used to be, where you could just say supply here, demand here, stock here. It's not that way anymore. I think you got to be a lot smarter about thinking through what is impacting the psyche of investors. I think in 2014 and 2015, the energy prices were plummeting, and people didn't want to touch anything that had anything to do with oil, and that included tankers, even though they were making more money than they had in years. So I think it's gotten a lot more complicated and a lot more detailed, and hopefully that means that guys like me add a lot more value to people.
Let me tell you two stories. One is when I first started, I got involved into the shipping industry for the first time around 17 years ago. And I went to the office of a prominent Greek ship owner from the island of Chios. And I asked him what the market is going to do. He told me the market is going to be very good. It's going to improve significantly. And I asked him why. I was right after business school. I was running correlations, supply-demand models. And this guy was in the market for 40 years. He told me that I went to Australia. And when I was in Australia, I was at the field and I touched the grain. So it's going to be a good year. He felt the grain. So I said, wow, that's what it takes. I mean, I've been to a lot of offices and I have heard, oh, it's my gut feeling. And apparently he was right. That was 2002. Market started improving 2003, and then this company went public, still public, has done phenomenally well. And I'll tell you another story. When I first joined at Morgan Stanley, and I was with our oil services analyst with Ole Slaughter, as you know it. We went to a local restaurant. After 4 bottles of wine, he told me, now you know what is the model, how to predict the tanker rates. Have another glass of wine. So this is the best that you can do. I mean, you can you can run your models, you can run your numbers. I was working with a private equity a few years ago that they were trying to predict the crude tanker market, and they were asking me why the multiplier for GDP is 4, or the multiplier of the shipments of the production over the shipments is 4 and it's not 4.2. And I said, I do not really know. We just put a multiplier there. It's just the direction that we are trying to forecast.
I'm sure the good people at MSI, who are a global sponsor of this event, probably don't agree with you, but any event. That's a fair point. Who else has thoughts on that? Gautam, anything you want to add?
No.
Okay. So it's certainly tricky. All right, let's pick another sector. We all heard Ben's panel before. I believe the exact quote is, you all should be buying the hell out of products. Who agrees? Okay. Oh, good. We have some debate. Let's start with the bull case this time. James, you get to lead off.
Well, I mean, if you look on the product tanker side, it's the same story as dry pretty much. You have a low order book. It looks like there's going to be enough in the market next year to absorb this additional supply coming in. You have the Chinese teapot refineries that were banned. They're allowed to refine now, and they're allowed to export a certain number. And then you have the mega refineries coming out in China, one that's coming out online end of this year. And that's going to help firm up the Pacific intra-Asian trade. And if you look at the U.S. is, the shale oil revelation is really helping. You have a lot of cheaper feedstocks. You're going to have a lot of U.S. exports to traditional long-haul trades and to new trades to, additional trades to Mexico. The Mexican refineries are not doing well. Throughput's not that great. So they're going to import more from the U.S. Latin America, another growing region. I mean, there's talk of, in the U.S. and Europe, about banning diesel and internal combustion engines, and Tesla's going to take over the world. But if you look at South America, they are still a long ways away from electric vehicles. They are going to use diesel and gasoline engines. The refineries there, they don't have refineries there. They have to import that from somewhere. And I think with all that demand, it's going to help the product tanker sector.
Okay, so who wants to do the bear case?
So I can go, but we're not really bearish, we're more neutral.
Okay.
And your question is for the next 12 months.
Sure.
I think longer term, we're more optimistic. In the shorter term, I think there's the order book overhang. A lot of vessels got delivered recently, and I think that's creating pressure on rates. But longer term, as he says, I think first of all, the intra-Asia trade on MRs, we expect to improve. Also, there's new refineries coming up in the Middle East, so that'll help the LRs.
Okay.
Just to add one thing, that the product tanker market, it looks like an interesting trade for a stock for the next 6 months, because order book next year is extremely low, and the stocks are very depressed. So it's a small improvement, it can have a huge upside. For a long-term investment, the problem is with the product tanker market. Since I started in shipping, I've been hearing about this dislocation of refineries that has never materialized, and the great opportunity of the product tankers that is coming, but it's been 17 years, and I'm sure that other people are much longer here than I am, and they are still waiting the product tanker market to be booming. One of the points that the difficulties with the product tanker call is that asset prices have not collapsed. You still have $32, $33 million MR prices. They are not expensive, but they are not particularly cheap to say it's easy to buy an asset today. If they were 28, 29, that would be an easy call, like you can say for the next 3 years, buying a crude tanker vessel, most likely you're not going to find it cheaper.
If I could just add one thing, I think Ben asked that prior panel what the risk is, what's the risk to that call, and I don't think we got a straight answer, but I mean, if I'm thinking about one big risk out there, if I think about what kind of got us into this mess in the first place, if you think about all the oversupply of crude that we had, all the refiners were just incentivized to run as much as possible, and that created this big refined product overhang that effectively meant everybody had too much of everything and nobody was trading, right? So if we get into that scenario again, where crude price suddenly sinks again, we get into the next OPEC meeting in March or April of next year, and they say, deal's off, forget it, we're bringing production back, crude gets cheaper, refineries run harder, we're in an oversupply situation again. I feel like that's something that could maybe ruin the party or take away the recovery.
That's helpful, thanks. I guess, I guess the question I've been dying to ask all you guys is public company CFO, and there's a lot of public company managers out there. So why do we all trade at discounts to NAV, and how do you help us get out of that conundrum?
Ask the regulators to take sell ratings off the table.
I think in the product tanker panel, Robert gave a pretty good answer to that. The reality is that typically stocks don't trade at discounts to NAV into perpetuity, and maybe there are a few of them that might, but the reality is it's about the stocks are more an indicator of investor interest. And so at the moment, the reality is, I think shipping stocks are seen as higher on the risk curve, and a lot of people are disinterested in taking really high speculative positions on really small companies and aren't willing to bid them up. But you go back 10 years, and it's happened cycle after cycle, when things are really crushing it and people are willing to sort of chase capital after this opportunity, the stocks trade at big premiums to their NAV. And if you do go back long enough, for both dry bulk and tankers, it actually evens out. Most stocks have historically traded at their NAV, but never at any one time. It's just that the upside is most typically offset the downside.
Okay. Well, not exactly. I was really hoping for the silver bullet, but we'll keep hoping.
I think that you need to raise more money for your company and start paying dividends. That's the only way you can.
Okay.
Mean reversion, that's the silver bullet.
Mean reversion. that's the
Keep raising money, paying dividends. You will always trade above NAV. You will raise even more money. Keep paying more dividends.
I think I've
And
heard some-
everybody, bankers will be happy.
Novel
analysts
idea.
will be
Sounds like
happy.
a tanker stock, I think.
It works, no?
It does work for a while until it doesn't work. You don't have to renew your fleet, right? You can just operate older vessels into perpetuity.
Oh yeah, 40-year-old vessels. They trade in Africa somewhere. It's okay.
They trade the same trade as a new build, right? So, okay.
You have young ships, so you can do it for the next 20 years, no?
Yes, that's true. All right, well, good advice. So I didn't know you had gotten into the investment banking business, but we'll certainly take that advice. I'm sorry, that probably makes the UBS compliance guy who's sitting in here somewhere extremely uncomfortable. I guess the one last segment I'd like to hit on, and I'm not going to ask you about LPG because unless you're bullish, I'm not going to like what you have to say anyway. So I'm not going to ask. But at any rate, let's switch it over to crude. We heard definitively from the entire panel they're not building, therefore the outlook's pretty good. James, okay, you already let off there. Anybody that James is a bear? Anybody else a bull here?
A bull or a bear?
Okay, John Gandolfo.
I'll say I'm definitely a little bit more constructive on the crude tanker space overall. Back again to the fundamentals that we're looking at, asset values on secondhand ships remain significantly depressed, yet these companies are still trading at discounts to their NAV. Especially the companies that have enough runway to push through weaker rates, whether it's going to be this quarter coming up to signal a stronger period, or we're looking towards the second half of 18. I think that the crude tanker space, particularly some of the better funded VLCC players, do have what it takes to come back into this market and basically deliver some significant returns on a risk-reward basis. And I think one of the things that we like to look at and we like to see is a company that within that space is trading at a significant discount to its peers, which will offer that additional upside, so to speak. If somebody is less bullish on the segment, they could always pair off that tanker risk with a different trade.
James?
So I think what's missing on the crude tanker space is what we saw in the dry bulk space. January of last year, Capesize daily rates were $1,000. And that forced a lot of ship owners to start really thinking about scrapping their vessels. And, we saw a lot of tonnage leave the market. The tanker sector, it's kind of been in purgatory. The rates have been bad, but then they rebound a bit. And, it seems like the outlook looks a little rosy, and then you have a quarter of bad earnings again. And so we're kind of in this up and down space. I think what we really need is really low rates for a prolonged period of time for a couple of quarters. I think that's going to really force ship owners' hands, especially owners with older tonnage. You have CapEx requirements for special surveys coming up, along with the scrubbers and the ballast water treatment systems. And with a prolonged period of low rates, how many ship owners are going to burn through $12 million outfitting a 15-year-old vessel when daily rates are $4,000 or $5,000 a day? So I think if we have that, and that forces a lot of tonnage to leave the market, I think, I can turn bullish in the crude tanker space.
All right, well, we've got about 5 minutes left, so this is the part you've all been waiting for, aside from Ben's witty repartee. So what is your best idea for whatever time period? Just tell us what's the next 3 months, 6 months, 12 months, long or short, and a specific name, not a sector. John?
Sticking with the tankers, I'm going to go with international seaways. I think they trade at a significant discount to their NAV, and I don't think it's warranted, particularly with the fact that they have two really cash flow positive JVs. And you get the pushback that they get. They have an older fleet. That older fleet has, through good markets, performed relatively at par with its peer group. So I think that's a name to watch out for.
Okay, so the company we're most bullish on is Scorpio Bulkers, again, because it is trading at the biggest discount to its NAV among the bulker stocks that we cover. We also like the fact that they have a modern fleet, which is a little bit less exposed to iron ore. It's more diversified cargo base.
I'm going to stick with my short on Nordic. I think Q3 is going to be really bad. I think Q4 is going to be really bad, and they're going to be forced to cut the dividend. They have CapEx requirements coming up for their new builds. They're going to have to raise money. What I think they're going to do is what they did in the past when they didn't have enough adequate cash to pay out the dividend. Is probably raise more money through equity, dilute the current shareholders, and pay out a dividend from that cash.
I'll repeat again about Golar. I think that the interesting long call right now for the next 3 to 6 months is Golar and the production of the FLNG. On the short side, unfortunately, most of these stocks, they have reached a very low valuation, so it's not very easy to make a confident short call.
Fair enough.
I think the one that I feel like might have the most capital appreciation potential is Navigator. I think to the extent that you might like this, hopefully the LPG side of the business is bottoming, but in their case, I think that they're developing a pretty big ethylene terminal. To the extent that they're successful with that, it could be quite impactful for the shares.
So I'm probably going to go long TK LNG Partners. It's an MLP, and it's in the LNG business, so I think we've got a few LNG bulls here. I think fundamentally, just first of all, LNG, prime for recovery. It's already off the bottoms here, and I think as we head into 18 and 19, it seems like the market's going to get tighter and tighter, potentially be in an undersupply situation by 2020. And I think when you look at that name specifically, it's got catalysts outside of just the LNG market. Specifically, they have not brought back their distribution yet from when they cut it about 2 years ago. And so I think that's a catalyst that's coming, not imminently, but maybe towards the middle of 2018, I'd say, is when they start getting a little more serious about bringing that distribution back. If you think about where that distribution used to be, at a 10% yield, this could be a $28 stock. It's trading at 18 today, give or take. At a 7% yield, which is what it used to yield before the cut, that could be a $40 stock. Like I said, it's 18 today. So it seems like the upside is just asymmetric to the downside here. So that's going to be my pick, TGP.
That was a great answer. All of them are great, and I've written them all down, so when we reassemble next year, we'll see how everyone did.
Portfolio does.
Exactly. So as there's only a minute and 30 seconds between you and a drink, I think we'll allow you to ask our panelists questions as you may be able to grab them at drinks. I want to thank all of our panelists. They did a fantastic job. Round of applause for them, please.
Before you go out, let me call Ted Jarek, who is the chairman of our conference, to actually close the conference. And thank you to everybody.
That's cruel and unusual punishment.
I'm not going to keep you. Thank you, everybody, for your attendance and participation today. At the outset, we said we thought it had a good group of panels and speakers. Hopefully that played itself out. I certainly thought it was a very entertaining and insightful day. Thank you again, everyone, for being here. Let's get a drink.